Vanguard Target Retirement Funds try to give you the best possible long-term outcome. They do that by dialing down risk over time, but they're beautifully simple because you only have to worry about one thing, which is when you retire. Everything else is based around that one number. So you don't have to worry about asset allocation, you don't have to worry about rebalancing, and you don't have to worry about what level of risk you're taking. That's all built into that target retirement date. So let's find out a little bit more detail about how these funds work. Remember, this is not a recommendation. If you want financial advice tailored to your circumstances, seek independent financial advice. The fundamental concept you have to understand when thinking about target retirement funds is time. This is how the stock price varies for a single stock in the FTSE 100, and this is the price variation over a day. And it's completely unpredictable. Some people have described it as a random walk, as if you were just flipping a coin. And we can contrast that with the movement of the FTSE 100 over decades. You still get the random movement, you can see the fluctuations over a very short timescale, but what dominates over the long term is drift. If companies can grow their earnings, then the prices follow those earnings up over time. Of course, there are bumps and volatility on the way, but over the long term, this drift dominates volatility. And that's why long-term investors look through the daily volatility to the long-term returns. Let's see how the historic outcomes have looked as we increase our investment time horizon. The vertical red line marks the boundary between positive returns on the right and negative returns on the left. And you can see that for weekly returns, it's roughly evenly divided between positive returns and negative returns. And it's also extremely uncertain. It's very difficult to know what the return will be 1 week from now. If we increase our time horizon from a week to a month, you can see that the uncertainty has decreased. We get less very large positive and negative returns, and you might also start to notice a shift of the whole distribution to the right into positive territory, as the effect of drift starts to become more important. Over the period of a year, the shift into positive returns is becoming much clearer as drift becomes more important. And you can also see the reduced uncertainty about the returns over the period of a year. Over a decade, we can become very confident that the return will be positive. And if we look over a 30-year horizon, the return has never been negative, and we become much more confident about the return that we'll receive. Now, these are returns for the US S&P 500. If we did the same thing for the UK FTSE 100 or the FTSE 250, we'd see a very similar pattern. As we move from short investment horizons to long investment horizons, the return on equity indices becomes much more certain, and the upward drift on stocks dominates the day-to-day volatility on stocks. So while the short-term investor sees volatility, the long-term investor sees growth. And that leads to the key concept for target retirement funds, which is the glide path. When you're young, you can afford to take a very large risk, because as we saw, over the long term, equities tend to drift upwards. That means you can take a very large position in equity and ride out the volatility and gain from the capital growth. But you'd also take a small position in bonds in order to diversify your portfolio, just in case you do get a downturn. As you reach midlife, your investment horizon shrinks because you have less time to retirement, so you dial down the amount of equity and you increase the amount of bonds, but you can see your portfolio is still dominated by equity. And once you reach retirement, the amount of equity in your portfolio is roughly equal to the amount of bonds. You can see that Vanguard thinks about it as 4 phases in life, and the amount of equity in your portfolio, which is the primary driver of risk, reduces from 80% for phase 1 up to the age of about 43, down to a level of about 30% equity above the age of 75. Now, this approach doesn't guarantee great returns, but it uses that information about long-term returns on the stock market to take the greatest risk when you're young and squeeze the greatest amount out of capital return. Then, as you get older, you take less risk and preserve the capital growth which you've accumulated. We can take a more detailed look at the portfolio changes over time. This is the UK version of Vanguard Life Strategies, and you can see they've adapted it for UK investors. At age 25, 80% of the portfolio is in equity, and 20% of the portfolio is diversified in bonds. These provide some coupon, some income, and some diversification. Most of that 20% in bonds is invested outside the UK, but some of it is put into UK corporate and government bonds. That's defined as UK nominal bonds, where nominal means that it's not linked to the rate of inflation. And the non-sterling bonds are hedged. That's because the volatility of those bonds will be dominated by foreign exchange movements. And that volatility has been removed by hedging the bonds. And we see the same picture with the equity component. The vast majority of the equity money is invested outside the UK, and only about a fifth of your total investment is in UK equity at the age of 25. Once we move through phases 2, 3, and then move to phase 4, the focus of the fund moves to capital protection. In other words, preserving the capital which you've grown by investing in the stock market early on in the life of the retirement fund. And this capital also produces an income, or a coupon, because it's invested in global bonds. The mortal enemy of bonds is inflation. And that's why some of the bond component of the portfolio is moved into UK inflation-linked bonds. Now here the coupon payments, that's your income, but also the principal amount of the bonds is linked to a UK inflation index. And this really matters to you as you get older, because you have to buy services which are increasing in value. The price of food, the price of heating your house, the rates you pay to the council, all of these will increase over time. And inflation-linked bonds will provide an income that's linked to that rate of price growth. And the equity component of your portfolio past the age of 75 is not zero. It's still around 30%. Equity also provides some protection against inflation, because as prices rise, companies have some pricing power. They can increase the amount they charge for their products and services. Also, you may still get some capital growth towards the end of the life of the target retirement fund. Now, there's only one thing you have to think about when choosing a Vanguard target retirement fund, and that's the date of retirement. So which date do you choose? Vanguard have this beautiful table. You look up based on your birth year and your retirement age to see which retirement date is suitable for you. We can think about it in terms of this timeline as we go from the age of 0 to the age of 90. On the day you're born, you start a series of timed events. For example, you'll know your retirement age is around the age of 70. And statistics tell us you'll die about 90 years after you're born, given current life expectancy. Now for most people, they start earning at age 20, and their income gradually increases until they retire. And as you age, your living expenses also increase, but not quite as much as your income. You should try and budget so that's the case. Always try to spend less than you earn. And if you do, then you'll have some savings, which I've shown in green. Now, the idea of a target retirement fund is that those savings, or at least some of them, would go into one of these funds. It would grow in value, so then when you have expenses after you retire, you can sell some of your fund each year and pay for those expenses. And the name of the game is not to outlive your money. Now, I think these funds are badly named because they're not just for retirement. Let me explain what I mean. The typical viewer of my channel is born around 1995. That means they're going to die around 2085, sorry to tell you. In grey at the top are the dates when the target retirement funds mature, from 2020 up to 2075, because the target retirement funds go in 5-year increments. Given the current retirement age, people born in 1995 will retire in 2063, and that means that the 2060 fund would be the one that would be suitable for their retirement age. But what if you have a child in 2020 when you're age 25? As parents will know, suddenly your finances and your entire life look very different. Now that starts its own clock in terms of your expenses. For example, when your child's 19 in 2039, they may want to go to university, which could become very expensive in the future. So perhaps you want to put some money aside for your child's expenses. Well, in that case, why not put some money into a target retirement fund with a 2040 date? And weddings are also very expensive. Now, you don't know when they're going to get married or if they're going to get married, but let's say you think that'll happen around the age of 25. Well, in that case, you could put money into a 2045 fund. This is called the bucket approach to investing. You separate your investments into different investment horizons, and you take the greatest risk for the things which are going to pay out the furthest in the future. Vanguard Target Retirement Funds could provide a nice structured way of doing this. But one thing to bear in mind is that they're all highly correlated with one another, so you don't get any diversification benefits from holding more than one target retirement fund. As with any fund, it's really important to look at the fees that you pay to the fund manager. Fortunately, now we have MiFID II, and that means that all investment companies have to be transparent about their transaction costs. Previously, the only legal requirement was to tell you about the ongoing costs, the OCF figure. I've shown that OCF figure in blue, and that's 0.24% of your amount invested per year that you pay to Vanguard for these target retirement funds. And that's true of any of the funds from 2015 up to 2065. On top of that, you'll pay some account fee. If you hold the fund with Vanguard, that will cost you 0.15% of the amount you invest per year. And now we have this new information about the transaction costs, which will add another 0.1%. But you'll never pay that amount directly to Vanguard. It'll be implicit in the returns of the fund, because it'll be a drag on your returns of between 0.09% and 0.11%, depending on which fund it is that you own. So let's say you invest £10,000 into one of these funds. The account fee will be £15 a year. The transaction costs will be a £10 drag on your returns over a year. And the ongoing costs will be an additional £24 that you pay to Vanguard per year. So the total cost to you will be £50 per year on your £10,000. You can search on Morningstar for target date funds just to look at the competition, and you can see that Vanguard is very competitive as you'd expect. A company called Architas offer the Birthstar target date funds, and those have an ongoing charge of 0.55% per year. That's 2.3 times higher than that of Vanguard. Fidelity's target date funds charge 1.95% per year, which is 8 times higher than that of Vanguard. But this depends on the share class which you buy. Some charge an even higher fee. As investors, we care about performance. So how have these funds performed to date? Let's start by looking at the risk. Now what you'd expect is that the risk would reduce over time. And if we look at the volatility of the target retirement funds, from the 2015 to the 2050 fund, that's exactly what we see. The 2015 fund has already passed the retirement date, which means it's now in its low-risk phase 4, and the volatility there is just 5.4%. And that means the typical percentage price move per year is 5%, up or down. As we shift further in time with the retirement date, the volatility moves up to around 9%. So still very low compared to an index like the S&P 500. For a typical stock index, the volatility is usually around 20%. So clearly this is benefiting from the diversification, even in phase 1 when the volatility should be highest. The UK version of Vanguard Target Retirement Funds were launched at the end of 2015, so we only have about 3 years of history. But if we look at the risk-return plot, so low-risk, low-return funds are in the bottom left, high-risk, high-return funds are in the top right, you can see they're arranged in this nice neat order. The annualized return varies from 6% per year up to around 10% per year as we go from the lowest risk fund to the highest risk fund. Another way to think about that is to track the value of £10,000 invested into each of those funds at inception at the end of 2015. The pink line with the lowest return is the 2015 fund, because that has had the least equity and benefited least from the very strong rally that we've seen. But notice that it also fell less in the sell-off at the beginning of 2018, just as it was designed to. The funds which gave the best returns were the 2050 and 2055 fund, and these contain the most equity. If you've got any questions at all about target retirement funds or any other investment questions, you can contact me via pensioncraft.com. Also, I'd love to hear whether anybody else is using target retirement funds for things other than retirement, such as putting aside money for your family, or other known expenses in future. And if you don't want to miss any of our videos, remember you can always subscribe to our channel by clicking the button on this page.